Hello and welcome to Hedgeye NexGen, where we're going to continue to help you build wealth while breaking down finance into its simplest form. As always, I'm Ryan Ricci, and we're joined by Ish.
Thanks for having me.
Thank you. Great to have you. We have a very exciting topic. We are talking all things U.S. national debt.
Very exciting.
We're going to break it down into what is this? How did we get up into this mess? What's going on? Who do we owe? We will literally cover it all.
And we'll see that it's both exciting and more so concerning, I think.
Hopefully we don't get everybody too down the dumps on this nice Friday. All right, so U.S. national debt. Has everybody seen the debt clock? I think you just you can look it up on Google. You just type debt clock into Google, and then you get this nice little thing, right?
Yeah, that's good.
So a lot of numbers. Most people are like, I don't even know what this is or any of this. So first, the big thing is we have $37 trillion in debt.
All right. And from someone who has no idea what we're looking at here. Who is we?
So
who has the debt?
The U.S. government
Yeah.
has the debt.
The federal government.
The federal government has the debt.
Okay.
And so I'll explain what does this actually mean right now. Okay, so we're going to just break this down as if we're like a family. We're always a family here, but okay. So when you don't have money and you want to pay for things, right? You don't have enough money to pay for things like a school, a road, your defense. You go and you borrow money.
Okay.
Right? It's the same thing like as if you're borrowing for a car.
Like a loan or a credit card.
Exactly. It's the same exact thing. So you go borrow money. So the U.S. government does the same thing. They go to the market and they say, I needed to sell a bond, which is literally it's an IOU.
Right.
Okay? Now, somebody, it could be people, companies, or countries, okay, can go and say, okay, I will take this and you now owe me money.
Right, so if Japan buys a bond from the U.S. government, Japan is basically lending money to the government.
Yes.
And the government says, I'll pay you back later.
Exactly.
Okay.
Exactly. So we owe Japan
Yep.
in that case, okay?
And that's what comprises the 37 trillion.
That's
not just Japan, but
yes, exactly. That's the whole 37 trillion is we owe various countries and people this money, okay? So here's the thing. The government has to pay back the bond with interest.
Okay.
Okay, so let's just say this was a 4% loan, okay, and it was $1,000, okay? Year one, I'm going to pay $40, okay? Let's say it's a 30-year loan. I'm going to pay $40 every single year, and the last year, I'm going to pay $1,040. So over the 30 years, on the $1,000, I paid a total of $1,200 in just interest.
Oh, really?
Okay.
Okay.
Yes. And then on top of that, I have to pay you the $1,000.
Right, right.
So in total, I paid $2,200 in 30 years.
And, the benefit for you was you got that $1,000 you needed up front
Correct.
at the beginning of the 30 years.
Exactly.
But you end up paying double for it in the long run.
Exactly.
Okay.
Exactly. So, right, that's a $1,000 loan. Now let's just say this is a $37 trillion loan, okay, over 30 years. And let's just say all of our debt's 30 years and it's 4%, okay? We're going to pay $44 trillion over the 30 years in just interest payments, okay? And then at the end of the 37 years, we're going to have to pay off another $37 trillion just to cover the principal.
What we actually owed.
What you actually owed. So that in total, you would be paying $81 trillion. And that's how you would get your debt to $0.
Okay. And that is like an inconceivable amount of money, I think.
Correct. Right? So essentially, what that is like after 30 years, you pay your mortgage. And as you're paying and paying your mortgage, eventually you don't have a mortgage anymore. You don't owe anything. Everything you have is yours.
Yeah.
Right? And that's that.
So I think that's really interesting. What you're basically saying is, the debt clock says our outstanding debt is 37 trillion, but you're saying by the end of it, to get it to zero, it's pretty much actually going to be 81 trillion.
Yeah.
Okay.
Yes.
Wow.
Because you're going to have to pay off all your interest and the principal.
Yeah.
Now, so that here's like the pretty big thing. That's just not what the government does. They don't want to go to well, not that they don't want to. They won't go to $0, right? They're not actually going to pay it off. They are paying the interest because you have to pay that interest. Okay? Because if you don't pay that interest, you default, a bunch of bad things happen. So they're paying the interest. So they're paying that 44 trillion over 30 years. Mm-hmm. But what they're doing is at the end of the 30 years, instead of paying off that 37 trillion that they owe, they're just getting new loans to pay off the 37 trillion, and you restart the 30 years.
You pay interest on the new loan you took out.
Exactly.
You borrow 37 trillion at the end of your 30 years to pay off the 37 trillion you owe.
Yeah.
Now you just have you just restart the whole thing.
Okay. Exactly.
Interesting.
And so that's what they do. Every single time a bond or their IOU comes to the 30-year mark, so some of them are 5 years, 10 years, but for simplicity, let's just say the 30 years, they just issue a new IOU to pay off their old IOU.
And I would assume the amount grows over time because we didn't just take out 37 trillion and stop growing and spending from there. We continue to invest in other things.
Exactly.
So each cycle gets bigger than the last cycle.
It'll continue to grow and grow and grow. And so we're going to get to that, but I think it's basically like an infinite mortgage. Right? It's a mortgage that you just always pay and continuously pay. And not only are you continuously paying it, the government's basically saying, okay, I'm going to take out more and more and more mortgages. I'm just going to keep paying them.
Just keep kicking the can down
the road. And
they
keep kicking the can more and more down the road.
Yeah.
Okay?
Sounds great for them, I think. Sounds great.
And so it kind of sounds great. Like we'll get into why they're able to do this and how this is not great.
It's the infinite money glitch.
It kind of is an infinite money glitch. And so here's the thing. So yeah, you're right. The 37 trillion doesn't just stay at 37 trillion. Mm-hmm. It grows every year. So it's growing currently at 1.8 trillion every year.
And what is that coming from? Do you know?
Okay, so that is what you basically is your budget deficit. So when you see the budget deficit, that's that number.
The budget deficit is like how much we're kind of overspending.
Exactly.
Okay.
And so when they overspend, since they don't actually have that money, they need to issue new debt in order to pay those obligations.
Yep.
Right? So if your budget deficit, which currently is like 1.8 trillion, 1.8, 1.9, right? That means so in 2025, it's 37 trillion, right? You have a budget deficit of 1.9, that 37 trillion goes down to 39 trillion, mm-hmm. right? And then they're going to have to pay the interest payments on those for 30 years and so forth. And so the amount that they're paying just continues to rise and rise because they're running a deficit. It's just like if you were working, right? And you make, let's just say, $30 a week, right? But you're spending $50 mm-hmm. on that week. You have a deficit of $20. You would say, where do I get this money from? You'd be like, well, actually, I don't have this money. Where the government just says, I'll issue some debt and I'll pay for it.
Take out a loan, cover the $20, pay it back later.
And pay it back later. Yeah. And that's how they do it. So okay. That's the deficit. It's literally just think of a person.
And I guess like the real impact of that, because they never actually pay off the principal they owed and they just keep pushing it on. The real impact is because that principal amount is growing, the amount of interest they owe every year is also growing.
Exactly.
So their expenses are just endlessly increasing.
Exactly. And the problem with interest that we've gone over on this show is interest is kind of like dead money. It's not going to grow your economy. It's not going towards investments. It's literally just paying the bank in this form. It's paying other countries, right? It's not helping your economy or anything. It's
helping them. They're making income.
Yes.
Off of us.
Correct.
Because,
Exactly. And for us, it's pretty. So you basically have your dead money line keeps growing and growing and growing, so much so that it's currently our defense budget our interest payments are more than where our defense budget is.
Just the defense budget.
Just the exactly.
Wow.
So we're how are you going to pay for this stuff?
Yeah.
All this money that the government's giving out, they don't have it, essentially, right?
Mm-hmm.
Right. So like Social Security, they don't really have the money, right? Money comes in, money goes out, right? The new roads that they're building, they don't have the money to build those new roads. They need
Take more debt, and so I guess defense budget's our biggest expense, right?
Yes.
Besides maybe interest now on our outstanding debt.
Yes.
And we're spending as much as that. As much as what we're investing in our defense there's an equal amount of that going towards dead money.
Yeah.
Zero investment for us.
Yeah.
I guess they'd make the case that, oh, well, we invested, we paid off these interest payments in exchange for being able to invest in, bridges, infrastructure, Social Security, defense today. We couldn't have invested in all those categories had we not had the debt outstanding today. And we just bite the bullet and pay the interest on it. That's the case they'd make. Does that add up in the long run? I'm sure we'll get into that.
Right. But it's also like, well, let's say I'm a person, right? And I just continue to run this deficit for years on years on years. Eventually, am I ever going to make enough money to pay this off, right? Because you're almost like, I'm investing in my future.
Yeah, exactly.
And then eventually you're like, okay, it's the future. I'm 60 years old and I have $1 million of debt, and I don't even have enough money to pay the interest anymore.
Well, I guess in that case, old person who, they get to that age, they don't have the money, they're not going to make the income, they just die, and it's all gone, right?
Right, and the U.S. government's basically, we will never die.
Unless,
that's their thought.
Unless.
That's their thought, is that we will never die, we will never lose our prowess in the world economy. We are a permanent fixture, and we will, therefore, we can think longer term, and this longer term is, I will go into a boatload of debt right now, essentially.
Okay.
That's their
thought process.
That's the thought process. Okay, so now this budget deficit. So we are 1.8 trillion every single year is what we are
just giving away.
We're just giving away
donations.
I wouldn't say giving away or donations. It's way more like we're below our revenue line, and our expenses are 1.8 trillion more than our revenue. Mm-hmm. Okay. Yeah. From 1945 to 2013, on average, that number was 295 billion. We're at 2 trillion.
Up to when? 2013?
Up to 2013.
What happened?
Okay. From 2020 to 2024, in 2020, our budget deficit was 3.13 trillion. Okay. Our 2021, it was 2.77 trillion. 2022 is 1.38 trillion. 2023 was 1.7 trillion. 2024 is 1.8 trillion.
So 2020 is when our spending just really got out of control.
Yes.
And we reached the multi-trillion mark. And it's come down a little since 2020.
But it's nowhere near 2013 averages.
No. Multiples higher still.
Exactly. And so just kind of think about it, too. Wait, I'm going to do a little math here. 295 divided by 1.8. That's why. Wait 1 second, guys. 1.95 divided by 1.8. Okay. Wait.
Are you trying to
Yeah, I'm trying to see how many years this is.
How many years we can continue 1.8 trillion in annual expense?
No. It's 1.8 divided by 0.295. Okay, 6. So a 2 trillion is basically the equivalent of 6 years of budget deficits.
2 trillion.
So if you go look at your average, right, from 1945 to 2013, and you had a budget deficit of 295 billion.
Oh yeah.
Okay, just to put the 2 trillion into people's heads, that's equivalent to 6 years of budget deficits before 2013.
Right. So today's annual budget deficit is,
6 years of
is
spending.
what used to be done over 6 years, now in 1 year.
We're now doing it in 1 year.
That's insane.
Yeah, and we've been doing that for the past 5 years, right? And in fact,
We must be expecting a lot of growth down the line because that's a lot of spending.
yeah, in
We
fact,
have to be expecting the growth. That's you're banking
you
on it.
need growth in order to pay this off. You are if you don't grow, you're based. Well, we'll get into it, but it's not a good scenario. 2020, when we spent 3.13 trillion, that's equivalent to 10.6 years of spending.
In pre 2013.
Yes.
Okay.
In 1 year, they did 10.6 years of spending.
Really accelerated it past 2020. So I guess this is the result of COVID, right? When we had a lot of government intervention to kind of
Yes.
rein things in, keep things under control.
And the cost of that is what we're going into today, which is this debt problem.
There's no
that
free
we have.
lunch.
It was not free money. The government did not have that money to give you,
Yeah.
essentially. But they gave it to you anyways, and they went into debt for that.
And now they're like, how are we going to make it back?
Right. So how can the government borrow like this forever? Can they borrow like this forever? Is this a free money glitch? Let's get into that. Okay. So how do they get away with this? So the U.S. used to be seen, and still is considered seen, as the safest investment in the world. Right. It's the quote unquote risk-free rate.
Risk-free.
Right. And that's the U.S. Treasury 2-year yield. The
Right.
2-year note, that's the risk-free. So that's basically the market saying, we think this is the safest investment in the world.
And just to tie this back to how we started this, that investment, the 2-year treasury, it's a bond, right?
Yes.
And it's an IOU.
Exactly.
You're lending money to the government. They say, we'll pay you back later. And we call it risk-free because the whole world assumes, yeah, they're going to pay you back later. They always have.
Exactly. They always have, so they'll continue doing it.
Okay.
And it's essentially, instead of a 30-year IOU, it's a 2-year IOU.
Okay.
That's that. And so, yeah, that's the quote-unquote risk-free.
Got it.
So people trust that the U.S. will pay this back. But why do they have so much trust in us? One of the major reasons is the U.S. dollar is the world reserve currency.
Right.
So what does that mean? That means that over 60% of world trade, and in some part, in like APAC, it's like 98% of trade is done in U.S. dollars.
Really?
Yes.
So everyone's using dollars.
So you use U.S. dollars to trade.
Okay.
So if you want to sell your widgets out on the global scale, you need U.S. dollars,
Okay.
right? And everybody's using the U.S. dollars. They are the world reserve currency, right? So you need U.S. dollars to trade, right? Because they need to make money. Everybody needs to make money.
Right.
Here.
So everyone's got a lot of faith in the U.S. government. Like, we use your dollars, this whole thing, it can't go away. Everyone's relying on it.
Exactly.
Okay.
Exactly. And so what's the safest way to hold U.S. dollars? Buying treasury bonds. So that's why so many world and countries own our debt, is because they need it to trade, and the safest way for them to hold this is the U.S. Treasury.
And what makes that the safest way? Is it because then you just generate that risk-free percent?
Right, because you're generating every month, you're getting a payment in U.S. dollars.
Okay.
And then you can take those U.S. dollars that you're getting paid with and go spend them elsewhere, trade with everybody.
Reinvest.
But you're getting U.S. dollars, essentially.
Okay.
Because it's, quote-unquote, safer than their own currency. Mm-hmm. Right? So that's one way. A government can technically never default. Technically, right? It's just how you can default on a loan. Let's say you don't pay your mortgage, or you will default, right? Basically, you have an interest payment every month. If you don't hit it, you're defaulted, and the bank takes your house.
Yeah, my credit score gets destroyed.
Yeah, exactly.
Okay.
Doesn't exist for the U.S. government. How? Okay, the Federal Reserve can buy the bond. Okay, now you might say, wait, that is the government owing the government. And you're exactly correct.
I believe, and tell me if I'm wrong, the distinction they draw that makes it not technically the government trading with the government is the Federal Reserve is independent, right?
I don't even think they go that far.
I think they say that still.
Yeah, okay.
But
They do say they are independent.
It's supposed to be independent, but it does do what you're saying.
Yes.
And then you're like, well, is it independent?
Right. But where's the Federal Reserve's money come from?
Well, I
The
think
U.S. government. It's all one. It's all one government. They are funded by the government,
yeah,
so it's the
yeah.
government owing the government.
The Federal Reserve, they are the ones who like they issue new U.S. dollars. They print the money
So they
quite
can
literally.
print money. Yes.
And then if the U.S. government needs to sell more of its IOUs, it needs to raise money. It needs loans from people.
Yeah.
The Federal Reserve could just print money and buy them. Is that right?
Exactly.
Okay.
Exactly. So that's how they can never technically default because let's say they have a bad month, right? If you have a bad month, if you just had a printer and you can just say, okay, I needed $20. All right, here's the $20, and you print $20 and you give over $20. All of a sudden, you covered yourself,
Yeah.
right?
Yeah.
That's why they can technically never default.
It's like they could default, but they never will because they have the capability to avoid it through this
Yeah.
literal infinite money glitch.
Exactly. And what's kind of even weirder is they've actually gone away from actually printing. It's not even as much printing currency. It's literally like they can just add zeros to the bank account. It's all digital now.
Yeah, that's
And
true.
it's
Even easier, right?
So it's because it's all digital. It's pretty much just like if you had a Fidelity account, you could add a zero.
So like even more disconnected from how much money that is.
Yes.
You just add a digital zero.
Yes.
Okay.
Yes.
So
And so what happens is, and so you can track how much does the Federal Reserve own of the U.S. government's debt. So they currently own 4.2 trillion in treasuries. Okay, they've been selling a lot. They had it was closer to 6 trillion in 2020, but right now they have 4.2 trillion in treasuries and 2.1 trillion in MBS. Okay, so that. Just think, right? When the market was crashing, the housing market was crashing, the government stepped in as the buyer, so that because nobody else wanted to buy, so they stepped in to stop a crash, and they printed money to do that, and they have the MBS. Same thing with treasuries. It's essentially that, okay, nobody's really buying these treasuries, but we need to keep spending. I will step in, and I will create money for this.
So if the government ever runs out of money and they can't sell any more debt because no one wants to lend them any more money because maybe people don't trust that they're going to get paid back, the government will just raise the money from its own Federal Reserve. And that works because the Federal Reserve is responsible for the US dollar, which you said the whole world is still using. So even if the world isn't saying, hey, US government, we want to buy your debt, they are still saying we're going to use the US dollars, and they're therefore supporting this operation to continue.
Exactly, because they're using us.
Exactly. Yeah.
And so the biggest way to stop this infinite money glitch is you have one, inflation that gets out of control, and two is a loss of trust, right? And the loss of trust goes, okay, I'm going to stop using US dollars. I'm going to go to another currency. I don't need your treasury bills anymore. I'm going to go sell them all, and that's when you have really bad things happen to the U.S. economy.
So you're saying that the cycle breaks when some of these parties just stop participating. They either stop using U.S. dollars or they stop buying U.S. debt.
Exactly.
Okay.
Exactly. Because you need buyers, and the Fed is the last resort. The Fed does not want to step in. They're the last resort, but they can step in, right?
Yeah.
So let's say, how do you lose trust? Right? And you lose trust there's a lot of ways, but one is you think that the country will not repay its debt, but we already went over that. That's probably never going to happen because they can always just print money. The bigger one is inflation, right? Because you're printing money. And if you start printing too much money, then basically the $100 that you're getting, that those people are getting, right, is now, let's say it's worth $50 because that's how inflation works, right? Think about eggs, right? Your eggs, you used to be able to get them for $4. Now you can get them for $8. Your currency lost value.
Yeah.
Right? You can buy less.
So the inflation route is kind of the same thing as the loss of trust route in terms of what makes this fail. Because if the U.S. government, if the Federal Reserve abuses this power of printing money to lend money to the government too much, it's going to devalue the dollars that everyone else is using, and then they're going to stop using it, and it won't work anymore.
Exactly, because they don't want 30-year loans anymore.
Yeah.
Right? They're like,
Like, you're not going to pay me back in 30
right,
years.
you're not the $100 that you're going to pay me back with is going to be worth $50. I don't want your 30-year loan anymore.
Right.
So they stop buying the 30-year loan because what they basically say is, I need to get compensated more for this. So instead of me getting $100 at the end, I actually need $200. Right? And then they'll be like, okay, you give me $200 and then it's worth $100. Okay, maybe I'll take that, right? There's a market for it. But how do you get to actually, so that's a raise, right? That's a raise in payments that we have to make.
Can we do that?
Right? So how do you do that? That's when interest rates go up. Right? So now instead of it being 4%, right, that we're paying, we now have to pay 6%, maybe 8%. And that's essentially going to increase the interest payment, right? So that 44 trillion in interest, maybe now that goes up to 60 trillion.
I see.
70 trillion.
We probably don't want to do that.
That's where the inflation, if you keep inflating away your currency, people are going to start demanding higher and higher rates. And then, yes, you don't want that.
But you will have to if you want to keep going.
If you want to keep going and keep printing, you're going to have to do that. And then what's even worse is for the people, right? So that's the government. Okay, but for you, the people, how does this hurt you?
Oh, man.
Your mortgage rate, now it's a 10% mortgage, right? You remember 3% mortgages, 6% mortgages? Goodbye forever. 10% mortgage.
So now you also owe higher.
You, the
interest
people
payments,
in the
10%.
country, owe higher stuff. Car loans, now 9% loans. Maybe credit cards go up to 30%. Student loans, instead of having the federal one be 4%, it's now 8%. The private part of that student loan goes from 10% maybe to 20%. Oh, so now people can't even go to college, right? So it flows through your entire economy.
Kills everyone.
Yes.
Yeah.
When everybody else, all the other countries lose trust in you, they're going to start demanding more money, especially if you're going to print. Put the control print button, which is what we're doing. They're going to demand more money. The demand of more money is higher interest rates. The higher interest rates hurt the people because they can't. The only reason the U.S. has a 30-year fixed rate mortgage, by the way, everybody, that does not exist anywhere else in the world.
30-year fixed rate mortgages?
Does not exist. Most mortgages internationally are all variable rate mortgages.
See. Okay.
And they're not 30 years. They're more like maybe you get a 1-year fixed rate and then a 5-year variable, and you continue to refinance it.
And why is that? Why is it different?
Because they're not the world reserve currency. They're not the risk-free rate. They're not.
They can't put that much trust into a loan for 30 years, these other countries.
Exactly. People aren't buying the Swedish debt.
Yeah.
They're buying the U.S. debt.
Right.
Right? So just because we have that world reserve currency and everybody's trading in dollars, that affords us lower interest rates. It affords us to be able to get a 30-year fixed rate. It allows the people to grow wealth.
Okay.
And all this stuff. But the second you lose that, this stuff doesn't exist anymore.
Yeah.
And you really, the people will get hurt. Like us being the world reserve currency is unbelievable. It's the only reason we have, if you like our military, it's the only reason we have such a big military, right?
It's a great position to be in.
An unbelievable position. It's where all of our wealth comes from, right? U.S. is very wealthy. It's all because of this. Well, it's a lot because of this, right? People want to come here. Smart talent wants to come here. Smart talent won't want to come here anymore, right? Because it gets unaffordable. All this stuff starts to happen.
So it's a lot hinging on everyone using the dollar.
Yep.
But right now we're risking that today.
Exactly, because our deficit is the equivalent of 6 years of spending of what it used to be.
Right.
Right? People had trust because in 1924 to 2013, when we became the world reserve currency, we weren't spending out of our gourds, right?
And so that's what got us into the mess we're in now. It's just too much spending, overspending.
Yeah.
You know, it's like any random person. We had a credit card. We got a little trigger happy with it.
Yeah.
Went on a shopping spree. Now we're in too much debt.
And then that person keeps going into more debt. every single year, and you're like, hey, can you stop that actually? Like, this is actually a bad habit. Maybe you should go get some help. Like, nah, I'm going to keep going. I'm going to keep going.
Right.
That's,
And then, what would normally happen to that person is the bank would, close them out and that person goes bankrupt.
yep.
Will the rest of the world do that to us, the
Right.
government?
Exactly.
I
Will the rest of the world do it to us?
guess that's the question.
Exactly. And the other part, and the biggest way of loss of trust is a weakening economy, right? I think inflation's a very large part of it because we have that infinite money, or your economy weakens, right?
And that makes sense because, when you're giving someone an IOU and you're saying, I'm going to pay you back in 30 years, well, they're going to hope you make that money. But if your economy is slowing down, they're like, hey, I don't think you're going to make that money.
Exactly. Just think of it like as like an income. Let's say you're making $100,000. Now all of a sudden you're making $80,000 a year. It's going to be harder for you to repay that debt,
Right.
right? And that's what a weakening economy does. Okay, so we got a problem.
Yeah, definitely.
So how do we? Let's get into how we can pay off this debt. Okay.
Okay.
So
I'm hoping there's some solutions you got here.
yeah, let's hope so. Let's say you make $30,000, right? And you have a $10,000 in debt. It's going to be kind of hard. That's a third of your income, right? And it's going to be pretty hard for you to pay off all that debt, right? Now, just as I said, you start making $100,000 and you still have $10,000 in debt. It's a lot easier to pay that off, right? Because you went from making 30 to 100,000, it's less.
Yep.
Okay, that's one way. But now, let's say if you make $30,000 again, but your debt goes to $30,000 and you're even, it's going to be very hard to pay that off because the amount of income you're getting is how much debt you're in. Money's coming in, money's going out.
It's like a hamster wheel.
Exactly.
You're never going to catch up with that because you got to spend on things in the present. You'd have to not spend all of your income for a year, put it all towards the debt to erase that. It's impractical.
Yeah. Right. How are you going to pay for food?
Yeah, exactly.
Okay. Then let's go into, let's say you make $30,000, but you're now in $40,000 worth of debt. That means that you have a $10,000 and you're in a deficit.
Mm-hmm.
You need, you're basically screwed. Okay.
Yeah.
I mean, it's going to get harder and harder for you to pay off this debt the more and more it starts to balloon. And if you're going into more debt than you can pay off, it's bad. So there's a measure for that for the U.S. and the U.S. government. It's called the debt to GDP ratio. So everything over 100% is really bad. That means you have more debt than you do have money coming in.
GDP is kind of like our income. And
GDP is exactly just like a person's income.
Okay.
Want to guess what our debt to GDP is?
Debt to GDP. I could guess, I don't know, 3 times?
No, so it's 123%.
Okay. So like 1.2 times as
Yes.
much debt as we have income.
Yes.
Okay.
So we are that household.
The 40K, 30K household.
We are that household that makes 30K and has debt of 40K.
Yeah.
We are that. That's what the U.S. government currently is.
How do you get out of that?
Well, maybe we'll get to it. We have a slide here. Let's go to chart. It's probably chart 2. So here's a chart of our debt to GDP. All right, and you can kind of see it's really, let's see, it goes from 1962 all the way to 2007. Our debt to GDP was pretty steady. It was anywhere between 23 to 47%. That means our GDP was more than our debt was. Okay, kind of healthy.
Yeah.
Then in 07, 08 happens, and we bail out the financial system, right? Then, because we're bailing them out, that's the Fed had to buy things, right? The Fed's buying things, they're printing money, and all of a sudden, our debt to GDP starts to go up.
So we spent a little more than we had to save our banking system.
Yep.
Okay.
Yep. And so our debt to GDP percent has just been increasing until where it is now at 123%. Okay, and then what's even worse is then the government can actually project where it's going to be in the future because they know the interest payments that are coming up, and GDP is pretty much flat. It's not something that's crazy. So you can pretty decently know with how much interest you owe and your GDP growth rate what's going to be. Right? You would want your GDP to grow more than your debt is growing, and then you would be outgrowing your debt.
Right.
Not what's happening.
No.
Our debt is growing faster than our GDP is. So, and by, I don't know, you can pick 2054, how many years? 30 years from now, our debt to GDP will be 171.
And that's an estimate coming from the government itself.
That's the government itself is telling you this.
That we're not getting out of this.
We're not getting out of this. It's only going to get worse, and it's actually going to start to balloon on us and get way worse, way quicker.
And that assumes like best case scenario as well.
Exactly. If you have a recession in there, what is the government going to do?
Spend.
They're going to spend to get you out.
If you have a war,
they're going to spend.
Okay. So base case 172%. Right now we're at 123.
Yeah.
Already unhealthy, getting unhealthier.
Yep.
All right.
Yep. Exactly. We just passed a bill which was increasing how much we're spending. It's all the same stuff.
Okay, so it's just like not slowing down anytime soon.
No, it just got worse.
Continuing to pass bills, more spending.
Which is more spending. And remember, any spending, increase in spending that they're doing, they don't have the money.
So can we just accept this? We can just say, whatever.
If you just say whatever, then what essentially you're saying is in basically 30 years, you could lose the U.S. dollar status.
All the stuff we just said, those risk scenarios, what breaks the cycle, we're risking that.
Yes.
By saying whatever.
Yes.
Okay.
Yes. Welcome to mortgage rates of 10%.
Right.
Actually could go to 18%. Could go to 15%. Like you're risking being able to take out a loan to go to college.
I gotta buy a house before it's too late.
Right? But this is what you're risking.
Yeah.
Essentially.
The prosperity of the whole country.
Yes, your prosperity, because if this goes bad, the benefits you have as an American citizen go away.
Right.
And we have a lot of benefits. Go travel internationally, you'll see them. Okay? So the next question is, how does this relate to the past? Let's go to the next slide here. The last time we had this high of a GDP was World War II. We got into World War II, and we can get anyway. We're involved in World War II, right? And so the government starts spending more than it had, and that's what the last time our debt to GDP ratio was this high. And then you can see immediately thereafter it started to come right back down towards 40%. So basically, we had like this short spurt of spending because it's World War II, and that's the last time. We are not World War.
We're not in a war, not a world war, and it's higher than it was back then.
Yeah.
Okay.
Yes.
Yeah.
And they're projecting it to keep going up. It's not like a one-time.
Projecting it to keep going
thing.
up without any wars assumed.
Exactly.
That's pretty alarming,
It's nuts.
to say the least.
It is absolutely nuts. Okay, then you're like, okay, our current deficit levels, right? We can project them out, right? So we can see how much our deficit's going to be, because remember, that tells you how much new money they have to print. Okay, so if your deficit is going up, then it's bad. You're going to keep having to create IOUs. That's not good. So you can forecast where our deficit is going to be. Now you can go to the next slide. I'll just read out at the top.
And this is based on just how much spending we're expecting.
Yeah, because it's all mapped out.
Yep.
It's very clear. So currently, we're expecting in 2026 to have a deficit level of 7% all the way until 2029. Okay? In 08, it was a 9.8%. 09 was 8.7%. 2020 was at 14.7%. And 2021 was at 12.1%. So what does this kind of mean? Okay? If you just take out COVID and the GFC, or Great Financial Crisis, okay, then these next 4 years are going to be the largest deficits we've had over the last 65 years.
Wow. You're setting records here.
Yeah. And we're not in COVID anymore. Last time I checked, there's no pandemic.
Nope.
And the financial system's not collapsing.
Nope.
And we're going to have The biggest margin of deficit that we've ever had in the last 65 years.
In these coming.
In these coming 5 years.
Why?
That's the question.
We just don't know how to manage our spending anymore. We've lost it or something.
Yes.
Like, what are we spending on? There's no COVID, like you said. We don't have banks to bail out. We don't have a war to fund.
What are you spending this money on? Where is it going? Why are we? These are these are the right questions.
It's going somewhere.
Right. And so what they're risking is us and the future of the fact that, these countries will just keep accepting this and they'll keep buying our debt and don't worry about it.
Don't
right?
worry about it.
Right? Like, just don't worry about it. That's what they're trying.
Yeah.
Right? But the problem is that's a very risky business, because if they stop and the countries are like, hey, what the hell's going on here? And they start going somewhere else, then what?
It's all over.
Welcome to mortgage rates of over 10%.
18%.
Yeah.
Okay. That doesn't work. Not for us.
No, it shouldn't work for any of us.
Yeah.
At all. Let's see. Projected to be higher. Okay, so. All right. Trying to see where I am. All right. So, how do you fix this? You have 3 options.
Okay.
Okay. Here's one option: inflation. You can inflate your way out.
And what would that be? Like, print money to cover your deficit?
Exactly.
Okay.
You make it so that these $100 that you owe will print so much money that $100 in a year, 2 years' time is worth basically $0. So we just print. Yes.
We devalue the debt as well as the present currency, but also the debt.
Exactly. You print so much money that you devalue your dollar so much that your current debt, $37 trillion, doesn't seem like a lot because you create inflation. That's one way to do it.
I guess so, because when they inflate, they keep the dollars, and
Yeah.
the dollars that other people have become worth less, and those people aren't getting more dollars. So, like, the portion we owe stays fixed, and the portion the government has goes like this, and then they can easily cover that.
Exactly.
Okay.
Exactly.
It's just stealing money.
Yeah, and what's going to happen is people are going to lose trust in your currency. You're not going to be the world reserve currency anymore.
So not a perfect solution at all.
No, not at all.
Not really a solution.
It's just think about eggs at $8. You're complaining. Now imagine they're at $40.
Wow.
Right? They can do it. It is a way. Japan kind of tried this. Does not work for them. Their economy grows about 1% a year, and their own citizens got
Screwed.
Yeah, exactly.
Life ruined. Future
Exactly.
ruined.
And the Bank of Japan, which is our equivalent of the Fed, absorbed all the debt of Japan, and they actually still have a debt to GDP ratio of 250%, which is pretty much the exact same of when they started doing this. It didn't work at all.
Oh, so this was tried by
Yeah.
Japan.
Japan tried this.
Oh, wow.
Didn't work.
Okay, that's a good case study. Hopefully we don't try that.
Yeah, I think some people might say, well, Japan's different, like the people and the way they spend is different. But at the same time, okay, maybe it's different, but also like imagine having $40 eggs and try to pitch that to the American people.
Yeah, so Japan literally tried to just print infinite dollars, like, if not infinite, but a lot, to devalue the debt that they owe.
Yeah, have you ever looked up the if you go on the U.S. dollar to Japanese yen? No, it would be Japanese yen to U.S. dollar. Right?
JPY, I think.
JPY to U.S. dollar is currently
Oh,
at
yeah, I see.
0.006, which means $1 you can get basically 6 yen.
When did
Six pennies of yen.
Was this recent? It looks like it happened maybe 2011 to present.
About 2011, yeah.
Okay. Yeah, you can see the dollar has appreciated hugely against the Japanese yen.
Yeah.
I'm guessing since the start of that
Exactly.
effort they made.
Yeah, there you go. We got it up.
That's what happens.
Yeah, their currency crashed 52%.
Okay.
So imagine you go on the world stage and the thing that you get paid for is worth 52% less.
Yeah. So
that's a problem.
we really shouldn't do that because we are the world reserve currency.
Right, and you'll lose reserve currency status, and your currency will be worth less.
Yeah.
But this is what this. So you ever heard of modern portfolio theory or modern monetary theory?
Yeah, yeah.
That's what that is.
Just
Inflate away your problems.
okay.
And that's what we were doing for the. It was, what is it? Janet Yellen was doing it.
Mm-hmm.
Basically, it was the prior administration. That's what modern money theory is.
Yeah.
Inflate away your currency. That's what they tried.
Some solution that is.
Yeah. Well, the second solution is grow faster than your debt is increasing by.
Yeah, that's a solution. I mean, yeah, great. Like,
Right, and that
can you do it though?
That's very hard to do.
It's idealistic. That would be the solution, right?
Yes.
But
Grow more than your debt is growing.
yeah, it's not easier said than done.
Yep.
Right.
And then the third one is stop spending, slowly repay the debt. And that's the third solution.
That seems maybe the most practical. It doesn't sound practical, but the most practical. It's possible.
Just think about it if you were a person, right? If the person is, I have this debt problem. Okay, what do? I cut my expenses and I start to repay off the debt so my interest payment goes lower and I can start to live again.
Save money, pay down your debt. Just like every person, the U.S. government should try doing that.
Exactly.
But can they? They got a lot to spend on, and we're kind of in too deep.
Right. And so the problem that the government would say is, yeah, but if I stop growing money, I'm going to actually the economy is going to stop growing in the short term. And I need to get reelected in 4 years here, Ish. And if one of the best predictors of if I get reelected is if the economy's growing. Because people have jobs.
I see.
So why would I stop spending? The people are used to so much spending. I got to keep spending, if not spend more, so I seem better than the prior administration. So I got to keep spending.
It's a bit of misaligned incentives here because a president's term is 8 years if they get reelected at most. And their goal is to, uphold their own reputation. The more they spend, the better the economy does. But they're only focused on that short window.
Yeah.
And you can spend now, make the economy do well now, but it hurts us later. But they're not concerned with that.
They don't care. Okay. They'll be out.
Yeah.
It's somebody else's problem.
Yeah.
It's our problem.
It's everyone. It's their own kids' problem.
Yes.
These politicians, whoever it is.
Yeah, but they're making money now, so they'll be okay.
Yeah.
So that's why nobody ever does this. So then you're asking yourself, okay, how did we get into this situation in the first place, right? How are they able to do this? So let's go to the next chart. So it's actually, there's something called a debt ceiling. And legally, they cannot have debt higher than what the debt ceiling is. Okay, so what this chart is showing is the debt ceiling versus our actual debt.
This is a good chart.
Okay, and so they're like, okay, yeah, legally, I can't be higher than the debt ceiling, but you know what I can do? I can raise the debt ceiling.
Then you're never going to be higher than it.
And you'll never be higher than it. So that's every time the government is quote unquote shut down, right? It's how much should we raise the debt ceiling? How do you stop having debt go up? You stop raising the debt ceiling.
Yes.
And then legally, they cannot go over it.
They just can't seem to do that.
Goes right back to I need to get reelected.
Yeah, spending. We got to spend. They're just too focused on the short term. It doesn't make economical sense, though, over like a 50-year time frame.
Yeah.
Nobody's here for 50 years. They're here for 4 or 8 years. That's it.
Yep.
That's all they care about.
Yep.
I like how it showed like Republican versus Democrat.
It's
like
the same thing.
Everybody, we're all on the same page here.
It's raising the debt ceiling is one of the most unilateral, or like both of them just do it.
Biggest bipartisan.
It's a bipartisan
agreement.
thing. It's one of the biggest bipartisan. Yes, let's continue raising this. It's good for all of us.
Yeah.
Currently, the people in there.
It's good.
Right. So our debt basically just follows the debt ceiling. It's absolutely nuts.
That's awesome.
Then you're like, okay, our country's still buying our debt, right? Because that's the biggest way that you can see
how this is going.
How is this currently going?
Yeah.
And so the answer is kinda.
Kinda.
Okay, we're still liquid, but you're starting to see some major countries shifting. So put on this board, here's China. China's in red. They've actually started selling their treasuries, which means they're getting rid of our debt. So how much they're buying, instead of buying, they're actually selling, which means we need other countries. Not only, it's not just us that we need to buy, we need other countries to buy China's too.
So when it's above the zero line,
Yeah.
that's when they're buying treasuries.
That's when they're buying.
It looks like their periods of buying
Yeah.
became smaller and smaller over time, and
now they're just outright selling.
Yeah,
and what we're actually seeing with China is that they're buying things like gold. Just buying other things.
alternatives to
Yeah.
treasuries.
Exactly.
Okay.
You're just buying other things. If you go to the next slide here, you can see, so who do we owe all of this debt to? The biggest people is Japan. And you can see China's decline there on this, right? They peaked in about 2010, and ever since, China has been selling.
They said we don't want to hold U.S. debt.
We're not holding U.S. debt anymore, right? We're just selling it. UK are the ones buying it for some reason. They keep buying it, but
Hey,
so
we need them. Don't complain.
right? And so the whole thing is that we need people to step in to cover this China gap.
Yeah.
And we just need this to continue going. So it's it's kind of like the U.S. is like, well, people are still buying it, so it's not a problem right now, right? But what could happen is, oh, it's too late. You can get into that situation where everybody's selling at the same time, and nobody in the world wants to
Nobody's going to buy and close that gap fast enough.
close that gap fast enough, and that's what you call a crash.
Yeah.
And so they're playing with their reputation on the world stage.
Yeah, and I think there's also other proof of the declining demand for U.S. dollars and U.S. debt, like the whole BRICS narrative.
Yep.
I mean, that's been going on, but
Yep.
is that Brazil, Russia, India, China, South Africa? They have some alliance to basically say, let's stop using the U.S. dollar,
Exactly.
just outright.
Exactly, and that it's gaining traction. More and more people are interested in that. China's doing more business with Russia. So when China does more business with Russia, they don't use US dollars. They use other currencies, right? So when ties start to break with US, people are like, well, screw you and your currency. I'm going to use these other currencies. And then they get new trade partners, right? And then it's a new relationship. It's basically like a marriage. I will break up with you. I'll go to somewhere else. I'll just use their currencies and other currencies, other means instead.
Yeah.
That's how this all happens, basically. So that's also a way to gauge the sentiment around your currency as well.
Exactly. And there's more countries in that alliance other than the ones we listed.
Yeah.
They started it, I think, but there's a growing list.
And that's why the U.S. wants to shut it down, right? And
This is something the U.S. would go to war over, honestly,
maybe
because they know what this is going to do to them.
Yeah, and so one of the big things that we have digital assets here. So one of the things, we go to the last chart, which is interesting, is stablecoins are starting to become major holders of our debt.
Yeah.
So let's go over why would the U.S. want stablecoins to be large holders of U.S. debt? Think of it as passive money. It's like a 401k. It's passive money that's constantly going to buying the U.S. debt.
Like you said, they're trying to close that China gap.
Exactly.
Stablecoins are a new way to close that. It's like a new foreign country stepping in to buy, but it's something else.
Exactly. And so the more and more that people adopt something like a stablecoin, stablecoins hold U.S. debt, and so it's just this constant buyer of the debt to step in case other people start to leave and stop propping us up.
Yeah, and it's a huge opportunity for the U.S. because stablecoins are used globally. Like in countries like Turkey or Argentina, where they have hyperinflation and their local currencies are losing value rapidly, those people, they look to the U.S. dollar, which is the reserve currency, as a safe place to keep their money. Stablecoins provide easy access, so they're buying stablecoins, and every time they buy a stablecoin to just hold their money in, they're indirectly investing in U.S. debt.
Exactly.
And the U.S. loves that.
Exactly. Because it's more buyers.
Right.
But I think what they're missing is basically, right, a stable coin. Yeah, it's great and all, right, but it's not overall the answer, because what if stable coins say you're not the stable one anymore? This other country's the stable one, and they shift all their holdings to another government's treasuries.
Very
or
possible.
something else.
Gold.
whatever it might be.
Yeah.
So, so you still, yes,
It's just like
good,
a country that could,
but it's just like a country, and they can shift tides at somewhere else.
Right.
And I think that's a miss. Like your reputation is everything, and the more inflation, the higher debt, it's an issue. And if you just keep printing, it's only going to get worse. And it looks like over the next 5 years, we're going to print more than we ever have. And it's in relation to like, it's an '08.
Yeah.
And we're not in an '08.
This stablecoin thing is like maybe a temporary bandage, but like don't get too comfortable. You still need to rein in your spending.
Yeah.
Yeah.
Yep. Any questions on debt?
I think that was a great rundown, especially for people who aren't familiar with this issue. You know, we talk about it a lot at Hedgeye and just in macro research in general. A lot of people in the field are aware of this growing problem because it's a big concern. So.
Yeah, and it's not something that we can just say, oh well, because really the people who are going to pay for it are us.
Yeah, it affects everyone. And, you know, if you don't know about any of this, you probably see these numbers like 37 trillion, like the U.S. government debt, 37 trillion, they owe it. But if you know none of this, you're probably thinking, well, who do we owe it to? It's so big. We don't make that much money. Like, does it even matter? It just seems like a paper figure that's not real and doesn't have to be paid back.
Yeah.
But, you know, you just broke down who is owed to and what happens if it doesn't get paid back.
Exactly. And just overall think of it as if they're a person, right? And they're running a family. That they're a family. U.S. government is the family. They have income, and they have debt, right? And like, would you lend from somebody who's doing this?
Right.
Probably not. You probably stop lending from this person who's out of control.
Yeah.
And so, but the longer they're out of control, you're like, okay, you were great and all, but like, it's time for a little rehab over there.
Exactly.
And so yeah, that's it.
Yeah.
All right. We are going to wrap it up there, everybody. Thank you for joining us. Make sure to share with all your friends, please, or not. I don't really care. You should. We're Hedgeye NexGen. You can see us on Spotify. We are on Twitters as well. I'm Hedgeye AI. Issues.
HE Digital Assets.
HE Digital Assets. Yeah, we're Hedgeye NexGen. So if you go to Spotify, you search Hedgeye Podcast. We're Hedgeye NexGen and Hedgeye Podcast. And yeah, look out for these shorts. We're putting on YouTube as well. And that's all we got. Good luck out there.